Welcome back to the Million Dollar Plus series where we uncover the real strategies million dollar owners use to protect and grow their wealth under the big beautiful tax bill. If you are a high income earner, an entrepreneur, or someone who owns multiple business entities, this video is for you. By the end of this video, you will understand not only how accountable plans work, but also why they are one of the simplest IRS-approved ways to move money from your business to yourself, 100% tax-free. Let's break this down into 7 parts so you know exactly where we are at every step. Part 1, we're talking about foundation. Part 2, we're talking about a client story. Step 3, step-by-step implementation. And then part 4, scaling across entities. Part 5, planning beyond 2026. Part 6, common mistakes. And then part 7, some closing thoughts for you with your action plan. So let's get started. Let's move on to our first part, the foundation, how the accountable plan works. Let's start with the basics. What exactly is an accountable plan? And why would million dollar earners care? When you make over $1 million a year, every deductible dollar counts. The higher your income, the higher your marginal tax rate. And that means every legitimate business expense that can be deducted and reimbursed tax-free is a direct boost to your net worth. Most people think accountable plans are just for small business owners, but in reality, they are more valuable for high earners because they create a clean, legal way to transfer money from your company to yourself without triggering income tax. Now, let's lay out the 3 golden rules of the IRS. First, business connection. The expense must be ordinary and necessary for your business. 2, substantiation. You must document amount, time, place, and business purpose. 3, return of access. Any extra reimbursement must be paid back to the company within a reasonable time. Meet all 3 and your result is simple. Your company deducts the expense and you receive the cash tax-free. So right now, we are still in part 1 and what we have to cover is the why, the legal framework, and the rules that make accountable plan possible. Next, let's move into part 2 where I will show you how it works in an example with a client sample that you can relate to. So let's talk part 2 client story. So Nadia from Honolulu. Now that we understand the rules, let's bring this to life with an example. Meet Nadia, a client based in Honolulu. She owns 2 S Corp, one for her consulting business and another for her marketing agency. Together, her companies earn about $1.4 million per year. Before 2025, Nadia did what most high earners do. She paid for things like business travel, internet, and continuing education personally. Her companies took some deductions, but she never reimbursed herself for the legitimate expenses she was already paying out of pocket. After the Big Beautiful Tax Bill clarified the rule for digital documentation, we helped her implement accountable plans for both entities. Here's how we structure it. Step 1, we drafted a written plan, one for each company outlining reimbursable categories like travel, home office, and education. Step 2, we set up monthly tracking using digital receipts in Google Drive. Step 3, we use apps like Mileage IQ to capture mileage and detailed notes for each client trip. Step 4, we calculate her home office deduction by square footage. 140 square foot out of 12,000 total, so 12%. Step 5, we reimburse monthly with memo like accountable plan, March 2025. Step 6. We return any excess within 60 days. By the end of 2025, Nadia reimbursed herself $48,000 tax-free. Her corporation deducted it, and she didn't pay a penny of income tax on it. That one move alone saved her roughly $17,000 in federal tax, all within the rules. So that was part 2, an example of how a seven-figure earner can reclaim thousands of dollars without changing how they live or spend. Now let's move to part 3, where we will outline exactly how you can set it up for yourself, step by step. So part 3 is the implementation for $1 million earner step by step. If you are a high earner with an S-corp partnership or a management company, here's the exact roadmap. Step 1, draft your written policy. Keep it simple, one page is fine. State that you will reimburse expenses, meeting the IRS 3-part test. List categories like home office, travel, internet, and continuing education. Step 5, set up your digital system. You can use QuickBooks, Expensify, or even a dedicated Google Drive. Create folders for each month, label accountable plan. So January 2026, for example, and upload receipt as you go. Step 3, calculate allocation correctly. For your home office, measure the workspace and apply that percentage to your total utilities. Keep a one-page summary showing how you got the number. Step 4, reimburse yourself on a set schedule. Once a month or quarterly is ideal. Transfer funds from your business to personal account with descriptive memos. Step 5, return any excess. If the reimbursement exceeds your substantiated cost, write the money back. It keeps your plan compliant and your payment tax-free. Step 6, archive every year. Print or save a summary of reimbursement by category. Store it with business records. So that was the implementation process. Clean, consistent, and audit ready. You can literally systematize this once and let it run every month. Now that you know how to set it up, let's talk about scaling. What happens when you own multiple companies or have different streams of income? That helps us move to part 4, which is scaling the plan across multiple entities. As income grows, so do entities. Most $1 million earners don't just have one business. They might have S-corp for consulting, an LLC for real estate, and maybe a partnership for investment. So how do you handle reimbursement across all those? Here's the secret. Each employer must have its own accountable plan. You can use one plan for everything, but you can use one management system to keep them consistent. Here what that looks like. 1. Each company adopts its own written plan. 2. The management company coordinates reimbursement and record keeping. 3. Expenses are reimbursed by the specific entity they relate to. 4. Shared expenses are allocated proportionally between businesses. This method keeps everything legal, traceable, and smooth, especially when you have a CFO or bookkeeper managing multiple accounts. So far, we have covered the what, the how, and the structure. Now, in part 5, let's look forward how to maximize this as tax law change again after 2026. Let's move on to part 5, planning beyond 2026. The big beautiful tax bill gave us lower brackets, but those sunset after 2026, which means they wasn't give you new bracket per se, but they kept the TCJA bracket, right? But that was supposed to be lower than what real thing is going to be, especially for a higher income earner. So that means high earners will be facing higher marginal rate again, potentially, quite likely, making strategies like accountable plan even more valuable. Here's why they matter long term. Every reimbursed dollar lowers your business income. Reimbursement don't add to payroll tax or self-employment tax. They work regardless of future rate changes because they are built on permanent IRS rules, not temporary deductions. Here's how to plan ahead for 2026 and beyond. As family members who legitimately work in the business, their qualified expenses can also be reimbursed. Integrate across entities. Use one administrator but keep separate company accounts. Coordinate with your CPA. Reimbursement reduce qualified business income, so find your optimal balance between lower wages and higher QBI. Archive and review annually. Maintain digital and paper copies for at least 7 years. At this point, you are starting to see how the accountable plan is not just a deduction strategy. It's a long-term system for tax-free wealth transfer. But like all powerful tools, it only works if you avoid the traps. That brings us to part 6, the biggest misunderstandings and how to avoid them. Even experienced owner make mistakes here. Let's walk through the top 4. Mistake 1. Paying flat allowance. A $500 stipend is not the same as reimbursement. It's taxable. Always tie payment to extra expenses. Mistake 2. Skipping receipts. No documentation, no deduction. Every claim must have a date, vendor, and business purpose. Mistake 3. Mixing personal and business. Keep personal and business strictly separate. If you reimburse a personal expense, it becomes taxable compensation. Mistake 4. Forgetting to repay excess. This is the biggest red flag. If you are reimbursed too much and don't return it, the IRS can classify your whole plan as non-accountable, making all reimbursement taxable. We are now entering the final part 7, where I will wrap up the key mindset shift that separates organized, wealthy taxpayers from everyone else. Here's what I want you to take away with. An accountable plan isn't a loophole. It's an IRS-approved framework that rewards organization, consistency, and discipline. It lets you take expenses you're already paying, like your phone, your internet, your home office, and legally convert them into tax-free reimbursements. When done right, it doesn't just save taxes in 1 year, it builds a repeatable system that protects you as your income grows. So if you're earning 7 figures or you're on your way there, this is your reminder. Don't leave tax-free money on the table. Write the plan, track the expenses, reimburse yourself the right way. Because under the big beautiful tax bill, the owners who document and reimburse strategically don't just reduce taxes, they build permanent tax-free wealth. That was the full breakdown. 7 parts, 1 strategy, and a lifetime of benefits when you've done it right. If you found this helpful, make sure you check out the next video in the series. We will be diving into how high earners combine accountable plan with family employment strategy to take this even further.